Abercrombie and Fitch is down 50% year to date. Let's do a 1-minute discounted cash flow analysis and see if this is a value trap or value investment. Abercrombie & Fitch is a fashion retailer you thought died in 2010, but now it's back as two brands, Abercrombie & Fitch Young Adults and Hollister for teen. The teen brand is absolutely killing it. Full year 24, they did almost $5 billion in revenue, up 16% year over year, operating margins of 15%, record results. Q1, Q2 of 25, growth continues at 8%, 7% respectively. Margins still solid at 13 to 14%, despite all the headwinds. Strong financials, net cash on the balance sheet, aggressive buybacks. But fashion retail is fickle, tariffs just hit the supply chain, and consumer trends change fast. Now here's what's interesting. Return on invested capital, my favorite metric of a quality business, is 28%. That's great for a retailer. That shows that Abercrombie is able to reinvest profitably in its core business. And the competitors, not nearly as good. These are industry-leading return on invested capital. Margins, they have moved from 2 to 3% a few years ago to an amazing 15% now. It's a huge transformation. And growth, I'm going to look at 5% per year in a base scenario. Risks, familiar tariff risk, trend risk, and consumer squeeze. Young adults and teens spending weaken. The stock price right now is around $68. The PE ratio is 6.8, which is absurdly low compared to the retail average at around 15. But the wild one is the enterprise value to EBITDA is only 3 to 4 times. That's how you would price a business that's going out of business. A business is worth all the discount of its future cash flow, so in a base case scenario, if I say revenue grows by 5% annually, margins stabilize around 15%, give it a heavy weighted average cost of capital 11%, terminal growth of 2%, you get an intrinsic value of $130 to $145 per share. In bull case, you have about $140 a share, and even in bear case, you have as low as $70. The ironic thing is when you're a shareholder of a business that's trading below its intrinsic value and they're doing buybacks, you want it to stay cheap for longer. You want them buying back their own shares at a discount, just like you want to buy a stock at a discount. They've bought back 30% of their shares in the last 7 years. So if they're going to continue to buy back 10 to 20% of their shares per year, that's like your intrinsic ownership going up by 10 to 20% a year. I know it's unsatisfying to see the stock price stay low, but that's actually what you want. You want the stock price to stay low so that your ownership of the underlying business increases as much as possible. And then you want the stock to just shoot up so you have an exit point. To recap, they have a strong recent performance, improved brand, high return on invested capital, robust balance sheet. Market is pricing it like it's a weak company that has no potential upside. As long as Abercrombie can stay relevant and avoid discounting, the margin of safety is huge. The risks are it's a fashion retail business which is volatile and trend-driven, external risks like tariffs, and the market needs proof to ever escape from this value trap position. This is not investment advice. Let me know in the comments what stock you want me to do next.